Hey there. Welcome to the If Money Were Easy podcast, the show where we teach you how to expand what's possible with your money. We're your hosts, Neela Hummel
and Mary Beth Storjohann,
certified financial planners and co-CEOs of Abacus Wealth Partners. Today on the show, we're going to talk about interest rates are decreasing. What does that mean for your money?
So many questions.
So many questions. Do you think people are as excited about interest rates as we are?
No.
No. I would agree with that.
I mean, unless they're looking at it from a mortgage perspective, and even that's true. Discuss are not
right
moving too much.
Right.
So
I feel like people start paying attention to interest rates when it comes to savings accounts and shopping for a mortgage.
Right. Yeah. Right. And I think, and so from the broad public perspective, that's my thought. I think there's also the investment lens of it. And so if you do have any type of financing with variable interest rates, then there are those that are paying attention. But right. In general, no.
Just a straight no. So interest rates and fun being in the same sentence, not common.
Not common. I think they were very interesting when they got to zero. Right. There was very media, splashy. There was lots going on. I remember creating a lot of content around that years ago at this point in time. And that's what people hold on to. Right. That's exciting because what does that mean for your money? And that's, that was the media kind of globbed onto that one. Now we're seeing about this slow, gradual decreases or, there was 3 last year, 0.25%. Those are kind of just run of the mill. And I don't think that's actually splashy to anybody. So, we see it in the Wall Street Journal in the finance perspective, but I don't think we're seeing it. I mean, NBC Nightly News isn't necessarily talking about it at this point in time.
Right. So setting the stage, you mentioned the zero interest rate time, right? So following the great financial crisis, right? 2008, 2009, mortgage rates, the economy kind of blew up effectively, if anybody remembers that. And one of the things that the Fed did at that time was they brought the lending rate, the interest rate down to zero. And left it there for 6 years. So we got really used to these low interest rates, which meant, bondholders weren't making much money, savers weren't making much money, but it was super, super cheap to borrow money, right?
Right. And so talk about that, though, what that means. So savers weren't making much money, bondholders weren't making much money. What's the strategy behind the low, from the Fed's perspective, what's the strategy behind the 0% interest rate? Why are they so low? What is it meant to have consumers, the general public, do?
Right. So the Fed, one of the things they do is they manage interest rates, right? Because they want to make sure that they want to kind of strike the balance between a reasonable inflation rate, right? Their target is to have around a 2% inflation. They want a little bit inflation, but they don't want too much inflation. And they also don't want deflation, right? They basically want to find this sweet spot to help the economy hum. Right. And so generally when they jack interest rates up, it's because they're kind of either trying to slow things down. They're trying to temper inflation. They're trying to kind of put a little bit of friction in the market so that inflation is basically quelled. That's one.
They're trying to slow things down in terms of consumers spending less, less in demand. Because when things are cheap, there's a ton of demand. So what does that look like when you're saying they're trying to temper?
I guess they're introducing some friction, right? So generally the lower interest rates are, the easier it is for consumers to borrow and the easier it is for businesses to borrow.
Yep.
It just kind of greases economic wheels because you're well, if I can borrow money for this small amount, I don't even have to make that great of an investment and it still makes sense for me to borrow this money.
Yep.
Whereas when interest rates go up, you're making different trade-offs, right? You're ooh, if it's kind of a wash, I'm probably not going to borrow that money because I'm not necessarily sure that this investment's going to pay off.
Right.
So it helps slow things down, which helps kind of contract the economy a little bit. But the interesting thing is the Fed also wants there to be strong employment. And so they want to calm things down, but not so much that it causes unemployment.
Right.
So it's a really tricky balance.
So it's really you look at those, the scales and the weights, they're really trying to even those out. If you're thinking it, it's you can see you're moving rice grains from one side to the other, trying to make it so that you're not disrupting either side too much.
Exactly. Because that's, ultimately they want to ensure the stability in the financial markets.
Hmm.
So they want to promote stable prices, right? Like have a reasonable amount of inflation, but they also want maximum employment for the American people. And you can see if you move too much grain in one direction, you can throw one of those off in a pretty
Right.
big way. So there's a lot of I like to think about it as almost like it's kind of a blunt tool, but it's one of
Hmm.
the only ones that they can. But they're also, trying to keep the banking sector healthy as
Right.
well.
Right. And so, going into 2025, the Fed is expected to pull back potentially, the media say are
Right,
saying the Fed is expected to pull back on interest rate reductions, stabilize a bit. We don't know what to totally expect this year, but maybe
right.
more of the same of 2024, a little less here or there. Knowing that rates will likely stay the same or lessen just slightly, what does that mean for like the everyday public? Like, what does that mean for us? If we, looking at
Right.
our bank accounts, what does that mean for our lives? Or if I have credit card debt, what does that mean for me if I want to go buy a car? Like,
Yeah.
what are you looking at?
So the big thing is, and again, it depends on which side you're on. Are you on the saver side or are you on the
Hmm.
debtor
Hmm.
side? And I think
Let's
the big
tackle savers first.
savers first. So the
Savers
biggest thing
first.
that people are going to notice is that these juicy interest rates that people have been getting over the last couple years, those are going to start to fall. You've
Right.
probably noticed that they've started to fall a little bit recently,
Right.
which means, there was a time again during that 0% interest rate environment where high interest yield savings account
I would
they were
say,
paying like
yeah.
1%,
Yeah.
right?
Yeah.
And then they got
Exactly.
up to like 4 and 5% over the
Hmm.
last couple years and people are like, this is great.
Right.
But the difference is that inflation was higher now than it was those years ago. And
Hmm.
so while the absolute return has gone up, the relative return, right, from an inflation adjusted
Hmm.
basis wasn't that great.
Wasn't
But
that
we
great.
saw it, right? It's
Yep.
fun to see those
Well,
interest
yeah,
rates go
because
up.
you see it, you see the numbers, you see the interest hitting your bank account, but and then you're kind of looking at when you're buying eggs at the grocery store, but
Totally.
the hit is different, right? You're
Right.
you're kind of grumbling about one thing, but you're feeling good over here, but it's actually a net.
So
So
that's the
with
biggest that
yeah,
people feel it is that they're going to start seeing the interest rate in their savings accounts go down and they'll probably see bond yields start to fall.
yeah. So and for your savings accounts, this is for those of you that are not just banking at a big bank. We won't name any of the big banks around here, but if you have a savings account at a big bank, you're likely earning peanuts as it is already. So if you haven't gotten on the
Right.
high yield savings account train, that's where you're going to see. That's for people who have moved their money into high yield savings accounts are the ones who are seeing the higher interest rates, the 4 to 5%. Those are
Right.
the ones that are going to see the reduction. If you're banking with a general bank and have a general savings account, you're likely already pretty flat, to be honest.
Right.
So
Right. Do not keep meaningful amounts of cash in a regular
please
checking
don't.
or savings account.
I feel like we said that before, but if we
Friends
have,
don't
but
let friends keep copious amounts of
I
cash.
feel like that's like one of the big tips I give. When you're like out
Yeah.
there, you're like, oh, the high yield savings is always the one. It's just like a general. Like if I had a takeaway from any new friend that I met, it'd be like
Right.
a high yield savings account.
Right. And it's a simple one, but it's like short-term money that you need and emergency fund type money, basically like sinking funds, money that you're going to be using in the next, like honestly year or so, and just kind of the just in case money. Keep that aside in a high interest yield savings account. Get the high interest, but also don't keep too much cash because you're just on an inflation adjusted basis, you're still not doing great.
Right. And it varies as to how much cash you should or should not keep. Depends
Right.
on Neela's
You're
risk profile is different than mine. So,
Financial planners recommend 3 to 6 months of living expenses. More if you have, right, either a lower risk tolerance or you like run your own business and you just need more money
right,
in the bank, right?
right,
Yeah.
right.
But you're right. People have different risk profiles. I'm like, invest it, get it out of
Invest
there.
it. Invest it. I'm like, look at all this cash. So, anyways. Okay, so that's savers. Let's talk about just debt in general. Like there's different levels of debt in areas
Yeah,
where the decreased interest rates will hit. So debt holders that, credit cards. Will
right,
people see progress there again in a
right.
meaningful way?
Yeah. So where dropping interest rates really hit consumers is in variable debt, which includes credit cards, that includes, like home equity lines, anything where there's a floating rate, anything that is not fixed is
Hmm.
where that rate or those reductions will really hit. So yes, it will impact credit cards, but let's be honest, credit cards are unsecured loans. And
Right.
so the fact that your interest rate on your credit
That you're
card goes
paying
from,
it. Yeah.
yeah, 28 to 26%
It's
is
not.
still
Yeah.
bananas. And so this is not an invitation to rack up credit card debt because the rates that credit cards charge in terms of interest are just
Obscene.
nuts.
It's
Even in a
obscene.
0%, because even in a 0% interest rate environment, it's an unsecured debt. So like the best interest rate you'll ever get from a credit card in the current structure is like 15%, which is still, 150% what the S&P, has done historically. So just
Yep.
don't.
Yep. Just no. There we go. That's like, there's a lot of no's today. Just no. Now 2025 with the no's. All right. Mortgages. We talked about those
Mortgages.
briefly. So the Fed rate, the declines, they indirectly affect mortgage rates, right? We're hearing it. You would assume that when the Fed rate lowers interest rates, mortgage rates would therefore decline as well.
Right.
We're seeing just some volatility, like up and, depending on when you're checking the rates, like we're seeing some fluctuation in the markets. Generally, mortgage rates are expected to stay stable throughout 2025 in terms of where
Yeah.
they're at now. We're not going to get back to those 2-3% rates anytime soon, I
Right.
don't think. So tell me more about the impact there. Like, what do you see happening?
Yeah, I love that we mentioned that because as soon as people are really looking to buy a home or refinance their mortgage, they're really focusing on what the Fed does.
Mm-hmm.
But the Fed increasing or decreasing interest rates only indirectly affects mortgage rates,
Right.
right? Mortgage rates are more tied to the 10-year treasury. And they also, like, there's other information that goes into setting mortgage rates, including like new jobs added, inflation, general economic environment. And so it's not directly causal. So you're not going to see just because you see the Fed drop the interest rate by a quarter of a point
Right.
does not mean you're going to see a commensurate drop with mortgages.
Yeah.
So it's like indirectly connected, but it's not directly causal.
Yeah. Yeah. So I think in general, while lower interest rates may increase affordability slightly in your personal situation, there's not going to be a shift in the landscape of
Right.
like affordability across the spectrum for
Right.
buyers. And the
So
the issue is when rates do decrease from an affordability standpoint, prices typically tend to make up for it
right.
with
Right.
demand.
Right. So then what would you say to somebody who is shopping for a home or has a much higher mortgage rate and is looking to, refinance? What is your guidance heading into 2025? What do you tell them to do with the current interest rate environment?
A lot of the times, there's the financial planner aspect of it, which is, buy a home that you can afford and understanding the landscape, understanding the environment, understanding what you're locking yourself into. Like if interest rates are higher, they may decrease and you have the opportunity to refinance, right? You can crunch numbers along the way. When rates went down, years ago, like we refinanced our home multiple times, right? To capitalize on,
Right.
on that. I would say just be cautious. I always tend, there's over the years I've tended to have clients delay in buying to make sure they have more of a stabilized down payment so that they can handle the increase in a mortgage expense. And other ones are more risk tolerant, right? So take the higher payment, but know what you're locking yourself into. Know that you
Right.
have the emergency fund. Know that you're locking yourself into that job, or you need to stay in that higher income environment, and so you need to be ready to make those changes. And so I think it's just a balance. I would tell you to work with a planner, make sure you're making the best decision for yourself. Be prepared for rates to look similar to they are now. Go in with as big of a down payment as you can without wiping yourself out. I think that's the other
Right.
thing that a lot of first time home buyers do is they throw it all into the pot for the new home. They have nothing for emergency funds, for furnishing, for all of the upkeep that goes into it. So if you're somebody who's kind of going, you don't have necessarily the gift from parents, you're building your own fund on your own, trying to get that first home, I would say just go into it with eyes wide open and know that honestly, it's a slog. Some people
Yeah.
love it. My mother-in-law loves real estate and she like loves the game. And I mean, it's exciting, right? When you're in it and I think you're experienced at it, it's fantastic. I
Right.
don't know any new like first or second time home buyers who are like, this is the best, right? I think you have
Right.
to have experience in it.
Right. And I think, for first time home buyers, it is a challenging environment right now,
Mm-hmm.
right? The real estate market is still very wonky. You have a lot of
Right.
people who are sitting on homes that have artificially basically depressed supply because they're sitting on 3% mortgages.
Right.
And so it's really, we you did a whole episode on this.
Yep.
It's really expensive for those people to move. And so to your point, you basically had prices increase. And so you have high prices and you have higher interest rates,
Yeah.
which is tough. Although, we think it's high compared to like 2010
Yes. I was like, yeah,
standards.
we think it's high, but it's actually not, right? It's not 16%.
Right.
So, but it's not 16% on $100,000 homes, right? We're talking
Right.
California prices here. So
Right.
there's a bit of relativity.
Right.
But I remember was talking to my father-in-law recently. It's been a Storjohann thing. All the Storjohanns are getting new cars, like Brian and his brothers.
Yeah.
Everybody's getting new cars and talking about what people are paying for the cars. And my father-in-law was saying, like, I bought a house for that much in like 19,
Right.
it's like
Right.
1960 something,
And
1970.
we're like, thank you, Boomer. Thank you
Yeah,
for the
thank you. It was
reminder.
totally. It was just like, he's like mind boggling. Like yeah, it's amazing from that perspective. But so not only do we have people sitting on the 3% interest rates, that we also have older generations who are just staying in their homes.
Yeah.
Like they're staying put, right?
Right.
Versus moving in or downsizing. They're locking in again because of what the price of what they can get for their money. Like
Right.
they have the space, they're keeping the space they don't necessarily and wouldn't typically need, but what they're getting on the other side isn't necessarily worth the trade-off
Right.
as well.
It's just
So,
classic supply demand, right? That the supply is decreased. And so the remaining inventory kind of stays high artificially.
yeah.
So
Yeah.
it is tough. It's a tough environment.
Yeah. So to wrap it up, there's not going to be a lot of change here in the mortgage, the real estate
Right.
environment. I think for 2025, it's the same game that we've seen in the previous years, in the past few years. Rates might go down a little bit depending on where you locked in. If you are an existing homeowner, it might be beneficial to look at refinancing. If
Yeah.
you haven't done it already, depending on what rate you locked in and what year you did purchase your home. But it's still going to be
Right.
kind of a game out there,
Yeah.
in terms of, I'm sure you're hearing it too, like
Yeah.
14 bids on a home. Like it's just like, depending on the luck.
Right.
So
Right.
that's,
I
that's
do
the
like
game.
I like the advice of you're still at the end of the day, it's your finances.
Right.
So if you're getting into a home, make sure it's a home that you can afford. If you happen to be in a very cheap environment right now, like you're in a rent control apartment or something like that, and you're able to take this time to continue to increase your down payment, that's probably a good move.
Yep.
Right.
Yeah. The interesting thing, which just like a little digression here, and I don't know if we talked about this previously, but like from the affordability standpoint, making sure we talk about it's your personal situation. One of the things that's always been interesting to me is the home affordability calculators online
Yeah.
and what they tend to leave out in terms of
Right.
and this again, personal situation, work with a professional. What can you afford based on your income? But also, like, are you factoring in? Are you not putting anything into your 401k? Like,
Right.
are you looking to grow your family? Have you factored in potential if you're just married and you're buying a home and you don't have kids yet? Have you factored in childcare expenses into
Right.
your cash flow? Because that will be a mortgage payment or 1.5 times a mortgage payment potentially
You
when
bet.
that comes down the pipeline. So I think that's the other thing that is, we talk about it's personal depending on your, what's happening for you, but rates aside, making sure you're factoring in those things from a
Totally.
mortgage perspective.
And I think we have to remind everyone that just because a bank will lend you a certain amount of money, that
Yeah,
does not mean you can actually afford that,
it's true.
right? Banks
It's true.
will lend you more than most people are comfortable paying.
Mm-hmm.
So just be aware that like at the end of the day, just because the bank will give it to you, that doesn't mean it's the right move. See
Yep.
what makes sense in your overall financial plan.
Yeah. So flipping from mortgage, let's talk about so kind of in the same lines with credit cards, but let's talk about like the home equity lines. Like
Yep.
what does that look like for those that are, that's a little different. But
Yeah. So, that most mortgages that are being set these days are fixed rates. You
right.
can get adjustable rates. Generally, that means that it's set for, five, the rate is set for like 5, 7, maybe 10 years,
Yeah.
and then it floats. But there is a period of a fix, but there's been just like less of a spread between adjustable rate mortgages and fixed mortgages. So a lot of
Mm-hmm.
people are opting for fixed mortgages.
Mm-hmm.
Home equity lines are different because those tend to be rates that float daily, right?
Right.
So the Fed changes the interest rate, that's going to impact your home equity line like immediately. So any kind of line of credit that you have, that is a variable line. Interest rates go down, that's going to impact that. So, what we basically had over the last couple years, right? And I also just want to acknowledge that it has been very topsy-turvy for consumers for the past 2 years,
Oh my gosh,
right?
yes.
We went from like 0% environment to starting mid 2022. The Fed raised interest rates 11
Oh my gosh.
times.
Remember,
11.
just like living through that period as a financial planner, with like
It
not
was
even like just
crazy.
bananas.
Right.
Just
So,
like tick,
like,
tick,
it was like
tick, tick.
overnight, people went from like, wait, these are the rates that we're getting. And then all of a sudden, they just like skyrocketed. And so the Fed's really, well, it's only dropped it, what, three times?
Right. Right.
So it went up 11
Yeah.
times and it's come down three. So it's
Yeah.
been a little bit,
Right.
but not a lot. And so consumers for the first time were dealing with like interest rates. Oh, turns out we should be paying attention to that
Right.
because it's
That's people cared.
crazy.
Right. People care. Right.
People
Yeah.
cared.
Yeah.
And it was hard. And then they also were dealing with inflation for the first time,
Hmm.
right? As that there was no inflation for a long time. So I
Right.
just want to also just acknowledge like consumers, if it's felt crazy the last couple years, it's because it has been,
Yes. Right.
right? So it's been really hard.
Uh,
So
Going back to what we talked about at the beginning, do people care about interest rates? No, I think they care about inflation. Inflation, like so,
people
like
care
that
about inflation.
Yeah.
Yeah.
So I think that's
Right.
like one of the, you can talk about headlines and things that hit. I think interest rates and people also, it's like what do we like the frog in boiling water. Like you
Mm-hmm.
slowly adjust to like the
Right.
environment that we're the adaptability of it, right? And
Right.
like people kind of start to adjust, and so I don't think people pay as much attention. But inflation, I mean, it was very much a topic. I
Hits
think with
people.
yeah, with the,
Right. So going back to your question on home equity lines, like one of the things that we saw during the pandemic and really in the low interest environment is a lot of people staying in their homes and taking out home equity lines to do renovations because it
mm-hmm.
was cheap to do that.
Right.
But now floating rates, it's been a lot of people with home equity lines, they've had rates in like the 9% range, which
Right.
is a less compelling option. As those rates start to fall, I bet you we start to see an increase in construction.
Mm,
Because people start seeing that, okay, I'm going to be staying in this house because I
right.
got this 3% mortgage rate.
Right.
Now I'm going to fix it up.
Yeah.
So I think that is where you might start to see some activity.
Yep.
And then the other one, you mentioned this with Brian's family buying cars, is auto loans.
Right.
Auto
Yep.
loans do get impacted by the interest rates in a big way.
Yeah.
So the lower, as those start to fall, like everybody can think back to commercials where it was like 0.9% APR financing. Like it's been a while since I've
It's been
seen
a
some of
while.
those.
It's been a while. I mean, we just went down a rabbit hole and we have the benefit, Brian's former military. So like credit unions, like we went down like a whole bunch of, shopping for the loans,
Right.
just to see. But yeah, it's fascinating. It'll be a long time till we get back there,
Right.
but rates still, and I think it's interesting too, where rates were too. Like, I think it was during COVID, like the demand for new cars, like, there was like a shortage,
Yep.
of like
Supply
of
issue.
supply, right? So I think that's kind of evened itself out.
Yeah. And I think, again, speaking to consumers, like the average credit card or the average auto payment in the US is almost $750.
This is bananas to me, by the way.
Bananas.
Like completely bananas. And that's like I just call me I don't know.
That's $9,000 a year.
It's
That means that
crazy.
you need to make at least $14,000 just to pay for that aspect of your car, not including gas, insurance, any of the other pieces. Like that is a lot. And I do
Wild.
think, again, consumers, this is tough, right? It is tough out there. So as you're making the trade-offs, like figuring out what is important to you and to your family, there is nothing wrong with driving that 12-year-old car,
Right.
right?
Right.
Cars are depreciating assets. It's different
They are.
than
Like,
buying a car is
it's like,
different
oh,
than
I was like,
buying a
I feel
home.
like I just said that, but I think I was talking to my father-in-law.
Yeah.
I was like, I would rather do the rental real estate all day long from like
Right.
like the payments. I'm like, give me some sort of
Right.
like return there.
Okay, so we've hit a lot of the variable pieces, a lot of individual consumers. What about business owners?
So, I mean, it's similar to consumers. I mean, lower interest rates obviously make financing more attractive,
Right.
right? So you can then borrow to invest in other areas of your business that would potentially contribute to growth. So
Right.
while it's still like it's more attractive for finance, the difference is kind of maybe if you borrowed like student loans. Student loans are supposed to therefore help you get an education and therefore your income earning potential goes higher. So it adds value there. So same thing from a business perspective, lower interest rates make financing more attractive. You can therefore borrow to invest in growth, in areas of growth, whether it's new hires or equipment to make your business more efficient, which will then, add to the bottom line, increase efficiencies and make you more money. So from that
Right.
perspective, it's a good thing as
Right.
rates go down.
Right. Can kind of grease the wheels of the economy to
Right.
some degree because
Mm-hmm.
more businesses might be willing to invest in larger workforces or
Right.
equipment or what have you.
Yeah. And then on the other side, when interest rates are high, it's expensive to borrow. Businesses aren't looking to make those investments and they're going to make
Right.
maybe more strategic decisions in terms of cutting or saving and, downsizing and being more efficient in other areas.
Right.
On the P&L. So
Right.
I think there's pros and cons there, but that is it tends to lower interest rates do tend to lead to, I think, business expansion in
Right.
some areas.
And I realize you mentioned student loans. We didn't really talk about those. Those
We
can kind
didn't.
of go either way,
Right.
right? If you have fixed rate loans, public
Mm-hmm.
loans that have already been created, there's
Right.
not going to be any changes. But if you have private loans with variable interest rates,
Yes.
you will see impacts there.
Yep. Yep. Yeah. So that's interest rates. Exciting stuff for Neela and
It is
I.
exciting stuff.
We actually like talking about this stuff. And so it was funny when we talked about like, it's interesting to other people. No, but I track it. I look at it. I mean, if it impacts
Yeah.
you personally, it's interesting depending on like where you're at in your life too. If you have loans that are impacted by like the
Right.
movement in rates and just like in the trickle down effect of it, right? So if an interest rate changes,
Right.
what does that impact in the economy? How does that impact and flow down to like you as an individual consumer?
Right.
Ideally, clients aren't worrying about this because they have planners and the people are living their lives, right? Nobody, our job is
Right.
to actually pay attention to these and kind of run the numbers and nickel and dime things. But
Right.
ultimately, I think it's important to understand how the rates work and what they can impact on a bigger picture scale.
Right. And controlling what you can control,
Mm-hmm.
right? We make different financial decisions based on the economic environment. So while we can't
Right.
necessarily control the economic environment, we can make adjustments based on the reality.
Right.
Right. And I think it's also interesting because our perception of things is also uniquely tied to how we've experienced it, right? So
Mm-hmm.
millennials and Gen Z and their experience with the last 15 years has been a very interesting experience compared to people who were taking mortgages out, say in the
Oh,
80s,
right.
right?
Right.
Because they're like, wait a second, you think a 6.5% mortgage rate is high?
Absolutely.
Try 18.5%. That
Right.
was my, during the Volcker inflation years,
Right.
that was my mortgage rate.
Right.
And then to your point, you're like, yeah, and homes weren't nearly what
They
they
weren't,
are
but also
today.
wages maybe weren't necessarily where they are today either. And
Right.
so it's all part of a story, right? So we always pull our like claims out of a bag, but that's kind of
Right.
like it doesn't paint a full picture, right?
Right.
So I think there is benefit from hearing both sides and understanding
Right.
like the complexities, but it's an interesting dialogue. And I think we both nerd out a bit on the history of it, right?
Yeah.
And just like understanding like what have we personally lived through, what have clients lived through, like what
Right.
are like the upcoming generations, like what are they looking at? And the landscape, I mean, it is shifting. It's influenced by different factors, but it's still, I mean, it's cyclical as well. So I mean, I
Right.
should say it's like it's different than, maybe what boomers have experienced, but it's
Right.
cyclical. You learned that economics 101. So
Right.
yeah.
It's exciting stuff. And
Yep.
we're gonna live through many more cycles. So buckle up and do what you need to do for your own personal situation to make the interest rate environment work for you.
Okay. Thanks, y'all.
Thank you. Thank you for joining us for another episode of If Money Were Easy. We hope you're walking away with some fresh insights, maybe some inspiration, and some ideas to apply to your finances, life, etc.
If you're excited about these conversations, we would love for you to follow or subscribe on your favorite podcast platform and YouTube. It's one of the best ways for you to support the show, and that way you will never miss the latest from us.
We're also turning If Money Were Easy into a community, and we'd love your help building support. So leave us a review, share your favorite episode with a friend, and we'd be super grateful.
We are also launching a newsletter. There you will get the episode updates, behind the scenes content, all of the bloopers from Neela and I, and what we are reading, watching, and listening. You will find the sign up link in our profiles.
The bloopers are choice, just going to say. They're really,
great.
really great. Please connect with us on Instagram. We're at Mary B. Storge and Neela Hummel CFP.
Thanks so much.
Thank you.